Hello and welcome to the Capital Stewards podcast. Today I'm going to walk through the economic proposals from the campaigns and evaluate which ones might be good for the economy and which ones might hurt the economy. If you're looking for a cable news show level discussion, this will not be that. If you are looking for real data with history and a deeper conversation about what actually works to drive growth and reduce inflation in the economy, that's the direction that we're going to go. Neither Vice President Harris nor former President Trump's proposals are all good or all bad. Whether you consider yourself a Democrat or a Republican or an independent, you might be surprised at the effectiveness of some of the proposals from your party. In my opinion, both sets of economic proposals need work. There are some good, some bad, but isn't that the beauty of compromise in our country? My hope is that this conversation will elevate the discussions that you're able to have with your friends, with your family as we head into Labor Day weekend and sort of the heart of campaign season. And I think the other reason that this conversation is important is because no matter who wins the election, whether it's the party you support or a different party, where there are opportunities to improve policy, I think we can all use our influence with the folks that we know in DC, with your local representatives, to help shape the future of policy proposals from both sides. So just because the election happens doesn't mean that the policy making is over. So hopefully the conversation we have today will help you shape some really informed views on what the proposals are, what's good and what's bad. I'm going to cover inflation, taxes, the minimum wage, housing, energy, a few other areas. At the end, as always, I'll talk about the implications for investors, try to make it practical. This is a long one, so you can skip ahead to specific sections using the links that are down in the show notes if you want to do that. So buckle up for the ride and let's dive into the economic policies of each campaign. So the most important economic issue to most Americans is inflation. In fact, I think the election might actually turn on the population's views of who has a better policy prescription for inflation. So I think it makes sense for us to start there. But before we dive into specific proposals, I want to take a step back and look at what caused inflation to start with over the last couple of years, because I think there's a lot of good and maybe not so good information out there. So when we look at the first chart, you can see on the gold line, that's GDP. And I think that's the most important thing to sort of anchor into as we start to look at the data here. You can see the gold line is growing in the late 2010s, and then COVID happens, that gray bar kind of in the middle of the chart, and you see economic growth go down negative very quickly, right? And then as we come out of the COVID recovery, it starts to sort of shoot back up again. You also see two lines on here that represent inflation. The red line is the headline CPI number that you hear about a lot, and you see that peaking around 9%. And then the peach line is core inflation, and that's what policy that's done in Washington can actually impact, right? There are lots of things in the CPI, gas prices, things like that, that interest rates, the Federal Reserve, the Treasury can't really do anything about. So we really look at core inflation when you see that in the peach line. And then the blue line at the bottom is the Federal Reserve's top interest rate. And we'll come back and talk about that a little bit in a minute. So let's just sort of walk through sequentially what happened post-COVID in the US. So COVID happens, we lock everyone down, which initially collapses the economy. You can see the sharp drop in activity in 2020. That's what I just mentioned. In addition to the spending slowdown as workers lost their jobs, they left the labor force because they either couldn't find a job initially, and it's hard to just continue to apply and get told no over and over again. They couldn't find a job, or they didn't want to go into work because they were afraid of the impact of getting COVID because of all the messaging that was coming out in the news. So that caused the labor force to shrink. So spending slows down, the labor force shrinks. That's actually what's supposed to happen during a recession, right? But nobody wants higher unemployment, right? I certainly don't want people to be out of a job. Nobody wants that. So the government response initially was a significant stimulus bill, and that was appropriate. That's what the government's supposed to do when we have big downturns, particularly when they're unexpected, is to step in and spend big. So the CARES Act of 2020, that's that first black line there, sent $1.9 trillion directly out to households and also to businesses to help them make payroll. As we move into 2021, the economy started to grow again. You see that gold line start to tick up, and it started to grow actually pretty rapidly. Some workers lost jobs when businesses closed, but others continued to work and get paid. Most of the workforce remained employed and they had their paycheck, plus now all those extra funds from the CARES Act coming in. And so the U.S. consumer started to do what it does best, and that's spend. And because we were on lockdown, where that spending went was very different than where it went in heat. The lockdowns created demand for more physical goods because people couldn't go to the nail salon and they couldn't travel as much. They weren't eating out as much. So the producers of athleisure attire and furniture are the places where people were spending their money. The problem is they couldn't keep up with demand because the key ingredient that they needed to produce more stuff was more people. And those people weren't available because they left the labor force. So the result is they increase prices because they've got more demand for their stuff than they can make. And so they say, hey, I should make more money and increase my prices. And so they do that. And when that happens, the result is inflation. I'm talking a lot about government spending here, but don't discount the impact of both state and national leaders who encourage workers not to go into physical workplaces. You know, if you tell everyone that they can get more sick than is really true, and then you start handing them cash, you know, through all of the stimulus bills that you're passing, that's a really strong incentive to stay home. And that created labor shortages, that drove up wages. And again, that sounds nice, but those increased wages were simply spent on higher prices at the store. So nobody was actually better off in that environment. If we had left well enough alone after 2020, perhaps inflation would have been transitory. The economy would have started to grow again. Workers would have eventually gone back to work. But even as the economy was clearly recovering in 2021, the government didn't stop spending. We had a new administration come in. The Biden administration passed the American Rescue Plan. That put more money into the economy. And the economy was, like I said, was already starting to grow again. And then they followed that up with the so-called Inflation Reduction Act, which, regardless of your political party, objectively had nothing to do with inflation. It was simply a spending bill. You can argue whether that was good spending or bad spending, but it was just spending. The government spending money doesn't, by definition, reduce inflation. So now inflation is simply not transitory, right? That becomes clear in 2022. And the Fed starts to raise rates. And why raise rates? Well, they essentially need to suck out all the stimulus dollars that were pumped into the economy in 2021 and 2022 that it didn't need. Raising rates means that more money goes to interest payments. It slows down M&A, slows down job creation. It quite literally undoes the things that the stimulus of a few months prior was doing. So now the Fed was not perfect here. So let's take a deeper look at sort of the Federal Reserve's role in all of this over the last couple of years. The Fed's balance sheet went from $4.5 trillion to almost $9 trillion. So a doubling of the balance sheet, which causes currency depreciation through inflation, right? At least $2 trillion of that increase was Treasury securities because somebody has to buy all of that debt the government is issuing when they do these big spending programs. And so the Fed is one of the big buyers of Treasury securities. The remainder of that spending, though, was mortgage bonds and a host of other things. And that's part of the reason why home prices exploded upward in 2021 and 22. Interest rates were originally kept low because the Fed is essentially buying almost all the new issuance in the mortgage market. So prices are going up, interest rates are down. That creates more inflation because housing prices are going. So the cause of inflation was really kind of a cocktail of events. It was lockdowns that lasted too long, right? Once we sort of initially lockdowns made a ton of sense. We didn't know what we were dealing with, right? Nobody should argue that, in March of 2020 that we shouldn't have locked the economy. And nobody knew what we were dealing with, right? So, but it was pretty clear by the summer of 2020, certainly by 2021, that COVID was not impacting younger folks in particular as much as we initially feared, right? Which is a good thing. But the lockdowns lasted too long. That created supply chain disruptions. That would have caused some inflation all on its own. But the peak in core inflation, I think, probably would have been 5%, not 6.5%. The issue would have been resolved when the lockdowns ended. People started to spend, they started going back out and sort of normalize their activity. But the government threw fuel on the fire with more spending, and that caused inflation to peak, core inflation to peak closer to 6.5%. And the Fed didn't help the problem because they kept buying mortgage bonds along the way, in addition to all those Treasury securities that were issued. So price levels are now high, and they are not going to go back to where they were pre-COVID. That would actually cause deflation. Prices generally are 20% higher. We don't want that kind of deflation in the economy. That's a whole different economic problem. If you were around in the financial crisis in 2007, 2008, that's not fun either. So what kind of prices keep inflation reined in where we are currently around 2.5%? The answer to that is letting the economy adapt more naturally to changes, less government intervention, forcing lockdowns, less spending when the economy is not in a deep recession. And then lastly, the Fed keeping their balance sheet stable and not bringing as much money. So where do the campaigns stand on that? Neither party, by the way, has been particularly good at reining in spending. The deficit has gone up under every president since Bill Clinton. Bush 43 spent more than Clinton. Obama spent more than Bush. Trump spent more. Biden spent more. So no one's hands are really clean here. Trump's proposals generally target the classic waste, fraud, and abuse type of cuts within the government. There's some more drastic proposals like eliminating entire government departments and stuff, but those didn't ultimately make the sort of Trump Force 47 plan, which is their official policy proposal for the campaign. So I think their real proposals are things that are more around the edges. It's also notable that Trump has been very clear that he's not going to cut Social Security or Medicare, but he's not proposing an increase. The Democratic policy statement, on the other hand, is proposing not only maintaining Social Security and Medicare, but actually increasing the payouts. So I did an entire podcast on Social Security a couple of months ago. It'll be hard enough for us to maintain that program in the late 2020s. And it is certainly on track to be bankrupt, as everybody says, by the mid 2030s, even if you take a conservative view of that. So there's a lot of content there. So I'd encourage you to go back and listen to that if you want a deep dive into Social Security. But the broader set of Democratic proposals, including climate change initiatives, handouts for housing, prescription drugs, there's not a lot of changes that would pay for those things. And we'll talk about taxing, right? Because the classic thing is, hey, we're going to tax, quote unquote, the rich, right, to pay for the handouts that we're going to do. I don't see enough sort of meat on the bones of the tax proposals. There's not enough revenue coming in to pay for all of the increased spending. So it's probably more deficit spending. So it probably drives higher inflation at the margin than what Trump is proposing. So let's talk about taxes. The proposals for taxes are pretty similar to the talking points from both sides. The Democratic platform wants to make the tax code more progressive, which progressive is simply sort of a big word for just saying we're going to increase taxes on high income earners and reduce taxes on low income earners. The Democrats are also proposing raising the estate tax and corporate income taxes, and then they would like to increase refundable credits to low income households and close loopholes. And we'll talk more about loopholes in a minute. Former President Trump cut taxes pretty significantly in his first term. And so his most significant tax proposal is really simply to make those tax cuts permanent. He's also recently proposed eliminating taxes on tips, which was then copied by Vice President Harris a few months later. So I'll cover that briefly in a moment. He's also talked a little bit about further reducing corporate income tax rates. So we'll talk about that as well. So now that we know where both parties stand, just like we did with inflation, I want to talk about the current tax environment, look at some real data, because I think, again, a lot of the talking points don't necessarily provide you with a really good foundation of what the tax environment actually looks like in real life. And then talk about what tax environment actually creates the best economy. And then we can evaluate the tax proposals, I think, from once we've got a framework to do so. So taxes fundamentally are a cost of doing business, and they are a drag on spending and saving. If taxes were zero, businesses would invest more and you would save and spend more, right? That shouldn't be a controversial statement. Intuitively, it makes sense that higher taxes impose a cost on businesses and consumers. The Tax Foundation, which is a middle of the road think tank, has published an amalgamation of research that shows that lower tax rates generate economic growth. Even the left-leaning Brookings Institute shows that lower tax rates have increased or have contributed to economic growth over history. So the impact of tax increases and decreases is not really controversial. That's why the battle is between more progressive. It's not between higher rates and lower rates, but it's between more progressive tax code, tax the rich more, tax the poor less, and then just lower taxes across the board on the right side of the aisle. The government does play a critical role, by the way, in society, and it's in everyone's interest for it to function properly. So we can't actually have a zero tax rate, right? That doesn't work. It's important for our economy to thrive that the government plays the right role in the economy. In addition to running the government, most people agree that, a capitalist economy needs some sort of safety net for those that are left behind by innovation and fall on hard times. It's called creative destruction for a reason. Jobs get destroyed. We need to be able to retrain, reskill folks, help them out when things don't go their way. And so we need taxes to pay for the government to make it work and to help those that are in need. And so the political debate then is what's the right level of all of that stuff and who should pay? So I'll start with the Democrats' plan, and I'll make a few points on the progressivity of the tax code, which is just a big word for analyzing the amount of taxes paid by relatively well-off families, like I mentioned earlier, versus the amount that's paid by lower income families. The U.S. tax code is very progressive. Anyone that says the rich don't pay their fair share is simply wrong. So when we look at this first chart in the tax section, you can see we've got all of the households in the U.S. divided out by quintiles. So basically the lowest earning households on the left, the highest income earning households on the right. And then on the left-hand side, you see the share of total federal tax liabilities. Some folks also call that the tax burden, right? Who's paying the taxes that are coming into the government? And then on the right-hand side, you can see the average federal tax rate. So what percentage of income on average are those groups paying? When we look at the chart on the left-hand side, the top quintile is literally the only group that pays a higher percentage of the taxes than their share of income. When you look at the different groups, if you look at the lowest quintile, right? So pre-tax income average, only $24,200, they pay effectively zero taxes, right? And then when you look at the next group, average income, $53,300, they pay 4% of taxes. They have 9% of the income. I put the income share on there. That's important. So they make 9% of the money in the US and they only pay 4% of the taxes. The middle quintile, right? They make 14% of the income. They only pay 9% of the taxes. So they pay less in taxes as a percentage of the taxes that the government takes in than they make in income. The fourth quintile, again, pays 18% of the taxes, but they make 20% of the income. And then it flips when we get to the last quintile. You can see the last quintile, they only make 55% of the income, but they pay almost 70% of the taxes. So they are the only group that actually pays a higher percentage of the taxes than the amount of income that they earn. So it's mathematically an incorrect statement to say that the rich or the highest income earners don't pay their fair share of taxes. They actually pay a higher percent of the taxes than the income that they earn. So you can make a political statement that should say, hey, what they're doing is not high enough. They should pay more in taxes. And that's a completely okay political argument to make. But the idea that it's not fair or somehow that sort of rich people are paying lower rates, it doesn't make sense. When we look at the right-hand side of the chart, you can also see the effective tax rates. I think this is really important because you'll hear a lot of times the famous Buffett example, which is that rich people pay lower effective tax rates than their secretary. That's the famous sort of Warren Buffett example, right? But if you look at the chart, you'll see the highest quintile of income earners, they pay the highest effective tax rate. And then it goes down through the income tiles and sort of the lowest income earners pay the lowest effective tax rate. So it's not true that the rich don't pay their fair share. It's also not true that the tax rate on the highest income earners on average, right, is lower. There's always edge cases, right? So this is averages. There's always a person, right, who has a really low effective tax rate, or a company has a really low effective tax rate for 1 year, or conversely, people that have really high effective tax rates for 1 year. But when you look on average, the sort of folks are paying their fair share and they're paying higher tax rates at the top than they are at the bottom. Again, a political discussion then is, should those be higher or lower? But the idea of sort of fairness is different. The other point that I'll make here is that the top 1% a lot of times get a lot of airtime, and I didn't break them out here, but if I broke them out, it wouldn't look any different. They pay more taxes than their income would dictate, and their tax rates are higher than any of the other groups on the chart. So there isn't really any funny business happening at the very, very top of the chart. The other thing that you hear a lot in campaigns is a discussion around, the economy's gotten more and more and more unfair over time. And so on the next chart, I just wanted to show what the tax burdens look like over time for each of those quintiles. So on the next chart, you can see the black line at the top is the highest quintile. So you can see their percentage share of federal tax liabilities has been drifting up over time. So the economy has not been getting sort of more unfair from a tax code perspective. The tax code is getting more and more progressive, or more and more favorable for lower income folks and less favorable for higher income folks as we've moved from 1979 all the way through 2020. You see those spikes again in 2020. It was a strange year. That's why I think it's kind of important to anchor things in 2019. I think you'll see that tick back down when we have the final tax data for 2021. But the only group that has seen their share of federal tax liabilities increase over time is the top quintile. All of the other shares over time, if you look back going to 1970, all those other shares have gone down. So we know the tax code is fairly progressive today. Like I said, it's really a political question then of, should it be more progressive, right? The wealthy certainly pay their fair share, but if you think that they should pay more in taxes, or that we should be giving refunds out, really, if you look at the bottom of the tax bracket today, the last two, effectively the lowest income Americans essentially don't pay taxes today. If you want to change that to where they're getting essentially a refund back, right, you can certainly do that. So you can make the code even more progressive than it is, but you're not working today in a place that I think is sort of fundamentally unfair. The next Democratic proposal is to raise the estate tax. This is only generally an issue for families with $25 million or more, right? Because the current estate tax exemption is $13.6 million. So until you're close to the 25 million mark, you're not in danger of owing estate taxes. Now, there's two ways they could do this. One, they could raise the rate. The other thing they could do to make more people subject to the estate taxes, lower that exemption back down to 7 or 8 million. So then, if you had 15 or 16 million, you might be closer to paying the estate tax. So So there's different ways that they can manipulate the estate tax, but the estate tax itself funds less than 1% of the federal budget. So it doesn't impact the economy very much because the top rate is so high. Families that are potentially subject to the estate tax do extensive financial planning to avoid it with folks like us. And increasing the estate tax rate or making more families subject to it simply encourages more estate planning to reduce estate taxes. More people start passing wealth earlier. They move more and more money out of their estate. The penalties for doing so are higher, so they take action to avoid paying estate taxes. So I'm not sure the juice is worth the squeeze here by the government, but if you feel like more money should be taxed when it's earned as income, and then again, just because someone dies with too much of it because they have some arbitrary amount that's higher than what we think someone should die with, then you can support an increased estate tax. The corporate income tax, I think, has much bigger implications for the economy, and that's the next Democratic sort of tax proposal. The current top tax rate for companies is 21%. The Democrats have proposed letting the Trump tax cuts expire, and then the result of that would be that the top corporate income tax rate would go back to 35%. Even more so than individuals, companies view taxes as a cost of doing business. Taxes are in every financial model for new business expansions and for M&A deals and for all kinds of things. So raising taxes by 14 percentage points or points in the bracket will cause prices to go up and investment spending and things to go down on the margin because it's going to make all of those things more expensive. Companies don't just say sort of woe's me and decide to earn less money every single year. They adapt to the tax regime that comes from the government. That's what corporate leaders get paid to do. The CBO projects that corporate taxes will bring in $525 billion in 2024. So a 14 percentage point rate hike is actually a 66% tax increase in percentage terms. So, in my math, that pulls in about another $350 billion. And that money comes out of the economy. It comes out of things that would be sort of productive, right, to create growth, to create jobs. And it goes to things that the government wants to spend on. Again, whether that's handouts to folks or government programs, you have to make a calculation and a judgment that the government is going to spend that $350 billion more effectively than how it was being spent in the private sector. I also think it's easy to think of companies as sort of like rich folks in ivory towers and these sort of nebulous things, but you have to remember that the ultimate owners of the largest companies in America are regular Americans that have 401k plans that are invested in index funds, our clients, pensions, nonprofits, et cetera. So that's $350 billion that won't be paid out in dividends or buybacks to those folks. And it's not going to get reinvested by the companies. It's simply going to go to the government. So that's what happens when we increase the corporate tax rate. I don't think that necessarily is a good idea. I'll close on the Democratic side of the tax proposals by talking about a few loopholes, and I put those in quotes. The reason I do that is because loopholes are not people cheating on their taxes. But I think that's really important to understand, especially the top income earners in the United States who typically have their taxes done by very good CPA firms. Those firms are not interested in losing their license. They're not interested in helping people cheat on their taxes. Loopholes are just carve-outs that were baked into the tax code to incentivize some kind of behavior. So anytime someone talks about closing a loophole, pay attention to what they're proposing and what behavior would change when they change the tax code. So usually closing loopholes is just a fancy way to say we're going to raise taxes. Democrats have generally targeted the changes that Trump made in his last administration in the 2016 Tax Cut and Jobs Act to when they think about what loopholes they might close. So some things that would be on the table there include opportunity zones, which provide tax breaks for investing in low income areas. So if you eliminate opportunity zones, that means less investment in low income areas. The qualified small business income deduction reduces taxes for small business owners. So the impact would be less income and investment into small businesses and startups across the country, potentially less innovation. That would be particularly burdensome if you were to then couple that with some changes to the capital gains structure. So you could actually have really detrimental impact to venture capital and technology innovation, things like that, if you were to both start taxing unrealized capital gains and get rid of small business stock exemptions and things like that. Bonus depreciation, that allows companies to get tax deductions now for their expenses now. So they're spending money today. But in the corporate tax world, a lot of times when we buy something that is really expensive, we have to take the expense for that against our income over a period of years. That's this whole concept called depreciation. And accelerated depreciation just means if I buy something today, I can take the expense today, and that lowers my current tax bill, and then I can recycle that money into more investments and spend more on different things. So the impact of changing accelerated depreciation would probably be to reduce investment in large capital goods, reduce M&A, things like that. The carried interest loophole is the last one. That's everybody's favorite whipping boy. Here, I actually think this is one that doesn't make a whole lot of sense. Carried interest is simply a bonus that equity fund managers receive for their work. They're not putting capital at risk, and they shouldn't get a preferential tax rate for their income for doing so. Incentive fees in the industry, I think, would still exist because folks like us, asset allocators, still want to incentivize manager outperformance. So this is one area where I think simplifying the tax code makes sense. And so if so-called loopholes get eliminated here, I think that probably would make sense. But I think what's important here is that I don't think that changing the carried interest loophole is going to cause people to not own private equity, or for private equity funds to go out of business, or for them to change the way that they invest, right? So I think that's a loophole probably that can go away. Some of those other things will actually create negative changes in the economy. So simplifying the tax code, I think, always makes sense. So one of the things that Trump did in 2016 is he lowered rates across the economy, and they also got rid of a lot of potential deductions and loopholes and things like that. So if we're going to lower the tax rate across the economy and then get rid of loopholes to make the whole system more simplistic, easier for folks to navigate, takes less time to figure out your taxes, and you can spend more time doing things that are productive and grow the economy. That's all good. That's very good policy. But if we're just eliminating loopholes and raising taxes, then we're right back to the conversation we were having before, which is, do we need to simply raise taxes? Lastly, on the Democratic side of the ticket, there have been various proposals for wealth taxes and taxing unrealized capital gains. I think taxing unrealized capital gains, frankly, is counterproductive because if the government taxes an unrealized capital gain, they're going to have to make some assumptions around having to return some portion of that money when asset prices invariably go down in the future. So they need to hold that money in some sort of earmarked government account, if you will, of money that we might owe to people who paid us capital gains taxes that they might ultimately not owe. So that means the net revenue to the government over time is the same as taxing capital gains when they're realized. I understand maybe there's some time value of money things, and maybe, the government gets the money and then they earn the interest on it. Yes, very marginal benefits for time value of money and things like that. But really, the total net revenue to the government is going to be pretty close to the same. So forcing people to make payments on unrealized gains is going to have a lot of undesirable consequences. When that happens, you're going to drive up market volatility. You're probably going to reduce funding to small businesses because people are going to want to be locked up in things that they can't sell. And you're definitely going to increase leverage because people are going to borrow to pay taxes on things that they can't sell. You're going to have a lot of market distortion that's going to happen as a result of doing that. And I think that's a lot of potential downside. We don't know because we've never had an unrealized capital gains tax in the US, but there's a lot of potential downside. There's not any upside because, again, the government tax receipts over time are the same because all of it gets settled eventually at some point in the future. So I think taxing unrealized capital gains is probably just not, frankly, very productive from an economic perspective. So let's look at the Republican side of the tax proposals. Trump's primary tax strategy is to keep his 2016 tax cuts in place. That results in lower taxes for both individuals and corporations as compared to Kamala Harris's plan. He recently floated the idea of reducing the corporate rate even further down to 15% from 21%. Corporations are subject to double taxation. So what that means is that when a company goes through their financials every year, they pay taxes on their earnings, on their profits. And then when they distribute money in the form of dividends or stock buybacks, the recipients of those things are taxed again, although at lower rates. So that's why we have preferential rates on capital gains, on dividends, because a lot of that money has already been taxed once at the corporate level. So all in, again, we talked about this earlier, lower tax rates we think are better for economic growth because it encourages people to spend money and save money and not redirect it to the government, as long, obviously, as we're not going so low that we can't run an effective government, right? So there's a balance there, but lower tends to be better. So that's probably good policy. Anytime we talk about tax cuts, the counter argument is always, well, what about the budget deficit and all the lost revenue? Like I mentioned, it is important that we have a good functioning government, that we pay for the government to function, that we pay for the social safety net. That's very important in this country. And I've talked about this before, but I want to look at a couple of charts that I think will maybe give us some perspective on sort of government spending and the deficit. So our first chart on government spending, the headline here is, I think the U.S. has a spending problem, not a revenue problem. That's obviously a subjective statement, but I think with data, I think that the data sort of bears that out, that we have a spending issue and not necessarily a revenue issue. So when we look at government spending as a percentage of GDP, so that's the red line on this chart, You can see it moving along over time. The historical average has been around 19% of GDP is what the government is spending every single year. And obviously government spending is going up and up and up because the economy is expanding. But what really matters is the size of government spending relative to the rest of the economy. And then if you look at the green line is revenue. And revenue, by the way, has historically run, not surprisingly, a little bit below government spending. But on average, it's about 17%. So it's a couple of percentage points below government spending, not too bad. But when we look over the last 10 years, if you look at the right-hand side of the chart from 2010 through 2020, you can start to see government spending really take off as a percentage of the economy. It took off during the financial crisis, and then it came down a little bit as we got a strong economy in the mid 2010s, but then it shot up again during COVID, and it's come down a little bit, but it hasn't come back down to where it was pre financial crisis from that perspective. So if you look now, government spending historically has been about 19% of GDP, and currently it's over 22%. Historically, revenue has been about 17%. We're actually slightly below that from a revenue perspective. So for the folks that want to raise taxes out there, there you go. You can raise taxes about 0.1% or so, and sort of get us back to historical tax averages. What you see, by the way, for tax revenue, I think this is an important point to make. It's very pro-cyclical, right? So when the economy is doing well, tax receipts go up. The economy grows, we get more taxes. When the economy does poorly, it goes down. That's simply what happens. So the tax code, the top tax rate, has actually gone down pretty materially over this time period. But yet the tax receipts as a percentage of GDP has remained pretty constant. The reason for that is because lower taxes helps the economy grow. So my view, number one, is that we have a spending problem, not a revenue problem, because you can see the huge spike in spending over the last 10, 15 years against a revenue that has stayed pretty constant. On the next page, you can see the debt to GDP ratio, right, which is what you hear so much banter about in the news. And you see that was certainly below 100% for a long time. We sort of moved along and it's been rising steadily over time. And then you saw it spike up during the financial crisis in 07 and 08, and then again during COVID when you get to the right-hand side of the chart. And so now we're sitting at about 122% debt to annual GDP. There is no magical number. No economist, I can't tell you, no one can tell you exactly how much debt the U.S. Economy can carry. We can carry debt until foreign investors and U.S. investors, all of the owners of U.S. Treasuries, decide that we have too much of it and that we should have less. And the problem is, that decision sort of happens very slowly and then all at once, right? So when demand starts to go down for U.S. Treasuries, that means that the interest rates are going to spike. They're going to spike very quickly, and we're not going to necessarily have a lot of time to make changes to react to that. So that's why you want to see this number going up very slowly over time, so that we can sort of course correct and spend more in bad times, spend less in good times. All those sorts of good hygiene things that you think when you think about running an effective government spending policy. So when we get back to Trump's policy proposals, again, I think lower taxes are better than higher taxes. And if you are of the belief, which I am, I think the data shows that we have a spending problem, not a tax problem, then I think you would argue for saying, hey, let's lower taxes, or at a minimum, let's keep them the same, right? Let's err on the side of keeping taxes lower. And let's figure out how to attack our deficit on the spending side, not on the taxation side of the equation. Trump recently proposed a no tax on tips policy. It's kind of funny, by the way. So we talked about private equity fund managers a minute ago. It's kind of funny that everyone supports no taxes on tips, but private equity managers should definitely pay higher rates on their tips, which are the carried interest performance fees that they get out of their fund. So it's just kind of funny how that works logically. This is another policy, the no tax on tips policy, that sounds good in practice, but it's difficult to implement. And the classic example of this is what happens when workers in industries that don't typically have a tipping policy start reducing their upfront prices and expecting clients to tip. We could charge, for example, $0 for financial planning and investment management, and then simply ask our clients for customary tips. And you might say, well, that would be crazy. No one would tip you. But if that became the norm across the industry, folks would pay the tips just like they do at restaurants, right? You do that at a restaurant because that's a normal way that you think about paying for those goods and services. So for what it's worth, Kamala Harris seems to have copycatted this policy proposal. So everybody thinks that taxes on tips should be effectively $0. I think both Trump and Harris are wrong on this one. I doubt it would get implemented. I think implementing it would be really challenging. I think it opens up a giant can of worms, and then you got to start defining what industries it's applicable to and not applicable to. I think, again, I think we should move to a tax framework that is simpler, not more complicated. And this would make it more complicated. If you want to lower taxes on folks that are typically in the service economy that are making less money, then just lower taxes on folks that are in the service economy that make less money. Don't get rid of taxes on a particular part of pay, like tips. So when we look at the tax plans as a whole, from my perspective, I think it's pretty easy to see the Trump plan is sort of extend lower tax rates, potentially further reduce rates if they can do that. I think that provides a better economic outcome based on what we know historically than one that's focused on sort of raising rates for various groups and making the tax code more complicated and probably leads to slower growth. So point for Trump on that one. Let's talk about tariffs. And this is one that's probably going to go the other way. Tariffs have been used by both parties over the course of history, and they generally create more harm than good. The last round of tariffs were implemented by President Trump in 2018 on imports from China. Surprisingly, President Biden left them in place at the beginning of his administration. So now everybody owns the tariffs, frankly. It's not just Republicans or Democrats. Everybody has had their hand in the tariff cookie jar. The intention behind tariffs or import quotas, which can function the same way. One is a tax you have to pay to import something. A quota is simply saying, we're only going to import 1,000 of these things. And so that effectively raises the prices on those things. Those things sound really good at campaign rallies. We impose a tariff, more products are made in the USA, more jobs get created and wages go up. All good, right? The problem is that companies don't simply say, well, shucks, we'll just have to pay more to import our stuff and make it here, and we'll make less money. They simply pass the tariffs on to consumers in the form of a price increase so that they can continue to make a competitive profit margin in those industries. So let's look at a recent example that I think will put this into context a little bit. So in 2016, there was a tariff that was put in place to limit the importation of washers to protect Whirlpool and other domestic washing machine producers from Samsung and LG in South Korea. Imports did go down as a result of the tariffs. Further, in this case, the foreign producers, Samsung and LG, and this was not helpful for Whirlpool, they just decided to build factories in America. So they built the stuff here. You say, oh, great, more jobs, right? Whirlpool was still in trouble after this whole saga went down because now their competitors could just use their lower cost production methods and they could make them in the US where they weren't, where the tariffs weren't applicable. Whirlpool did hire 200 more people over the time period that the tariffs were effective. And Samsung and LG hired 1,600 people in the US. So we got 1,800 new jobs, right? Whirlpool may be still in trouble, but it sounds like we're okay. The problem is that the price increases that resulted from the tariffs were really significant. Prices went up a total of $1.5 billion in the first year alone. That's more than $800,000 per job that got created. And they certainly don't pay $800,000 in washing machine factories per person per year. So consumers across the US paid the price for those new jobs, and the price was terribly inefficient for the economy. And by the way, the US washing machine industry is still uncompetitive with its foreign peers. The last round of tariffs that the Trump administration implemented, these were the so-called China tariffs, thus cost consumers an average of $625 a year, according to the Tax Foundation. The economy was humming along in 17, 18, 19, so we didn't notice those things so much. Goods prices were going down, but the tariffs still cost consumers money. And it doesn't, just because the economy was doing well, inflation was doing well, it doesn't remove the fact that tariffs in the markets where they were imposed were a direct cost or a direct tax on U.S. consumers. The standard of living goes up over time as goods and services become cheaper to produce. We want to produce goods at the lowest price possible so that the most people can benefit from a product. That makes logical sense, right? Making stuff at the lowest cost possible. That's what competition does in a capitalist economy. That competition might mean that some jobs move overseas and some jobs get eliminated. However, the economy creates more jobs and creates new jobs generally that require more skill and higher pay over time. That process is what drives up the standard of living in the U.S. And that process is what's made the standard of living in the U.S. the best in the developed world. And when we talk about large countries, by far, there are a few other countries that have higher GDP per capita, but they're really small. They tend to be like tax havens and things like that. So among large companies, the U.S. definitely leading the way in GDP per capita. So what would be a better approach from a government policy perspective is to say, hey, instead of taking that $1.5 billion out of the hands of consumers and spending, $800,000 out of everyone's pocket to save a few hundred jobs, in the markets that would have been impacted by washing machine facility closures. Let's spend a few $100,000 on each of the workers that are there. It won't cost $800,000, right? But let's spend some money on the workers that are there. Let's help them relocate if they need to. Let's help them learn new skills if they need to. Let's help them find jobs that are better, that ultimately pay even more than what they were doing before their job got moved overseas. So I think there are ways that the government can step in and help when the creative destruction process of the capitalist economy hurts consumers in small, sort of like localized areas around factories and things like that. There's definitely an opportunity for the government to step into those situations. And I think with retraining and other kinds of things, you can do it for a lot less money than what you end up doing when you impose a tariff and you pull billions and billions of dollars out of the US economy. Tariffs can be useful in a limited number of scenarios. That's really when we're talking about economic security and sort of national defense type purposes. Occasionally, foreign governments like China will spend government money to sponsor the production of a good at a price below the real market price. That's not, by the way, most goods are just cheaper in China, so China must be doing something bad. That's when the Chinese government basically gives money to industries to sponsor production at what would be a below market rate. If that happens, what they're trying to do is drive U.S. producers out of business. So in those cases, it does make sense for the government to use tariffs to level the playing field. There are also really good reasons to use tariffs to ensure domestic production of really advanced technology for military applications. But foreign government-sponsored production and military technology, that's fairly limited in scope. In those cases, by the way, the trade-offs are still negative for the economy. So it still acts like a tax. The end consumers still pay for the stuff. What we're saying in those situations is just that the geopolitical positioning outweighs the potential economic concerns. What Trump has proposed so far is basically adding tariffs to all imported goods or all imported goods from a country, even like China. That's bad policy. That hurts U.S. consumers. It drives up the cost of everything that everybody buys. It doesn't help the U.S. economy, even though it might sound good in an election season. So that one's a zonk against Trump. We should be looking for policies that are helping the U.S. be more competitive, help educate U.S. workers, those kinds of things, not imposing tariffs. Let's talk about raising the minimum wage. So the Democratic Party platform, the proposals are to raise the minimum wage to $15 by 2026. That effectively doubles the minimum wage in a lot of states, and it does it pretty quickly. So let me be unequivocally clear. This is not like open for discussion, not complicated. It's pretty straightforward. Raising the minimum wage reduces the number of available jobs, period. Not an opinion. If you ask any business owner, they will tell you that. So will a fair read of all the economic research literature that's been out there. There are lots of papers that suggest that a substantial number of workers would see hourly wage increases in a $15 minimum wage environment. That's very true, because if we employ people in the entry-level spaces in the U.S. economy, they're making minimum wage. If we raise the minimum wage, they get a raise. Roughly a fifth of American households make less than $30,000 a year. $30,000 a year is about the income level that $15 an hour creates on an annual basis. The problem with raising the minimum wage is that over time, companies replace the now higher cost workers with technology, or we just talked about outsourcing, or they outsource the jobs, right? As the price of employing a person increases, it becomes easier to trade that person off with something else. We don't have to go back in ancient history to see that happen. HBR, Harvard Business Review, just did a study in 2021 of workers in California grocery stores when the state of California raised the minimum wages every year sequentially in the early 2010s. The hourly wage went up for the workers that were working there. That makes sense. Hoorah, right? We cheer that. The problem is the total number of hours that everybody worked went down. More workers were employed, so they had more bodies employed, but there were fewer hours worked in total. And in particular, what happened in this case is that the grocery chains were employing more workers so that no one was working enough hours to be eligible for benefits. And so what that meant is the total pay to workers declined over that period of time, even though the hourly wage rate went up. Recently, California, again, increased the minimum wage on restaurant employees in 2024. In just a couple of months, 89% of restaurants have reduced hours. Have we seen that movie before? 70% have reduced the number of employees. I'm not shocked. It's almost as if the results of the prior economic policy from a decade ago just happened again. Food operators raised prices, not surprising. And by the way, that disproportionately impacts their low-income customers, right? And most of the big food service chains or quick service restaurants, things like that, said they're going to consider reducing future store openings in California because it costs too much to operate there. So a better approach than raising the minimum wage is to educate workers, help them acquire skills so that they can move from lower paying jobs into higher paying jobs over time. That's how America's supposed to work. That's the American dream. The minimum wage, by the way, should go up over time, so it shouldn't stay at $7.25 for forever. But the increase should be tied to inflation. It should move slowly over time, not sort of big arbitrary one-time increase. That's what creates layoffs and like sort of instant, mechanization and things like that. If you go into McDonald's, right, you're already ordering a lot of times on a computer screen. And so if you were to just immediately hike the minimum wage up, you would just see more things like that really, really quickly. So raise the minimum wage, but do it slowly and do it over time. Let's talk about the housing market. We know that housing affordability is a problem in the US. When we look at the next chart, you can see that housing supply has not kept up with demand. So we'll focus on the red line. The green line's a little bit noisy. It talks about household formation, but the red line, you can see the number of housing starts and the number of new homes that are being built in the US going up gradually from 1990 all the way to 2005. And then the great financial crisis hits and you see that number drop off dramatically as we go toward 2010. Developers got out of the business. We simply stopped building as many single family homes in the US. And then as we recovered from the financial crisis in the 2010s, the number did start to tick back up, but we still never got back to the number of houses that we were building in 2005 at the peak. And population of the US has continued to grow over that time. The number of households that are forming every single year has continued to grow over that period of time. So the housing supply in the country has not kept up with demand. That's fairly straightforward. I think a lot of us have experienced that when we go and look for houses. When we look at the policy proposals for both administrations, there's some good and some bad here on both sides. So Vice President Harris and the Democrats have talked about grants for home buyers in speeches. The Democratic Party platform also outlines an immediately refundable tax credit for $15,000 to first-time home buyers. There's also been some things talking about first-generation home buyers, things like that. Regardless of the exact amount or whether it's based on generational home ownership or not, this is not the right way to solve a housing problem. Simply handing out money to buy a specific item in a market that's capacity constrained simply drives up prices. It's just going to cost you more money to get the same house. We saw the same thing, by the way, happen during COVID. The government sends checks out to everyone. Supply is constrained. We can't produce as much of something as we need. And so that leads to inflation in 2021 and 2022. The same concept here. If we just start handing out money for people to buy houses, you're just going to get higher home prices. The right way to tackle home affordability is to incentivize home building. That'll increase the supply, promote competition, and drive prices down. It may not be popular to give tax cuts to developers or government subsidized loans to developers, but policies designed to encourage builders to build more homes would be more effective than handouts. President Harris recently proposed tax incentives for developing low-cost housing, so perhaps they're moving in the right direction on that. I think tax incentives are a better plan. That policy would make a lot of sense. On the other side of the aisle, the Trump proposal is to open up federal land for building houses. I don't know if there's enough federal land near urban centers for that to make a difference, but selling land to developers at reduced prices in exchange for limitations on the prices for the units that ultimately get built there, also an effective way to boost supply. So we want a housing policy to be targeted at supply, not at demand, or not at giving sort of more money to folks for them to buy the same amount of houses that are on the market today. I'll talk a little bit about price control. So this has come up recently. Kamala Harris making some comments lately about grocery pricing and price gouging and proposing legislation to fix that. So a couple of things are important. So typically when we hear about price controls, what we hear is that corporate profit margins are at all-time highs. That is true. The stock market is close to an all-time high. Corporate profits are high as well. Those two things are correlated. That's a good thing, not a bad thing. But those corporate profits are highest in information technology and other areas of the economy that are growing significantly. They are not nearly as high in the grocery space, in the food production space. Margins, operating income margins, I talked about this on LinkedIn last week, are in like the low single digits, 3 to 4% in a lot of grocery businesses, in a lot of food production businesses, in the consumer staples space. It's simply not a high margin place to operate. And what price controls do is essentially limit supply. So what happens when you impose a price control is you say, hey, okay, well, you guys are price gouging, so you're not allowed to sell ground beef for more than some amount. And what happens is the folks that are able to sell ground beef below the price control amount and still make a profit, stay in the industry, and everyone else exits. So all that does is create shortages. So when you look at countries that have price controls around the world, effectively what you see are lines and shortages for people to get the things that they need. So there's always an economic sort of rationing that happens, and it can either be with price and with money, or it can be with standing in line and waiting your turn or rationing. But price controls simply lead to shortages. We've seen that happen over and over and over again in the world. Price controls are not effective policy. And they're also not, I think, particularly relevant because, like I said, I don't see price gouging in the sort of grocery space. If you want to lower corporate profit margin, that's in technology, and it's not in super staples. Infrastructure. So this is one good proposal from both sides. Lots of infrastructure like highways, tunnels, airports, the energy grid. All of that benefits from federal sponsorship, from working together across state lines. Infrastructure investments generally lead to positive economic returns over time because businesses use the infrastructure in order to go to work, in order to build factories, in order to do new things. A lot of that infrastructure too requires immense capital upfront to build it, and it's really difficult for private companies to raise that kind of money. The returns are very long, over really long periods of time, sort of slow and steady. So that's an ideal expenditure for the federal government. So to the extent that both parties do have proposals around infrastructure, I think those are good things. Those are things we should encourage. When we think about the spending side of the federal ledger, you think about what are the things that the federal government can uniquely do really well, kind of like defense, right? Infrastructure is another thing where, the government can do that probably better than lots of other private organizations. One thing I didn't spend a lot of time on is energy. We could spend a whole podcast there. The overarching thing to remember is that energy and gas prices are a global market. So yes, it's good to produce more energy of all kinds in the US, but no amount of production in the US fully insulates us from what's happening in global energy markets. The US oil production has skyrocketed since 2000. Gas prices are also up since 2000 as well. So yes to more US production and letting the economy sort out clean energy versus sort of government mandates to try to get in there and do that. I think the economy is a much better sorter of where the best investment opportunities are versus the government. But just sort of ramping up US production doesn't necessarily help the economy in the short run. It doesn't necessarily have a direct correlation to reducing gas prices. We're still very dependent on other producers around the world. OPEC, Saudi Arabia, members of OPEC. There are other countries as well that produce lots of oil. And if any of those countries decide to reduce the amount of production, which they will to keep prices high, right? We've seen them do that. They intend to keep oil prices sort of where they are now. They're going to move their production around to do that. We can produce as much as they want, and they'll just continue to shut down their own production so that prices stay at a place where everybody's making money. So again, our inflation problem is not caused by higher energy prices, right? So trying to manipulate energy markets to get lower inflation is not the right answer. So we've covered a ton of ground today. I hope you found this conversation helpful and informative as you make your own views about the election, have discussions with your neighbors. The race is very close. National polling is basically dead even. Trump has a slight advantage in the Electoral College currently due to slight advantages, generally less than 1% in some of the swing states, but that can go either way. All of that's statistically insignificant. Harris is leading in the popular vote count. So it's really anybody's game to win or lose. As I mentioned before, an election night result one way or the other isn't reason alone to buy stocks or sell stocks or any other asset in your portfolio. The market does respond to elections over time, particularly within sectors. Based on the current set of policies that I've seen, I think you see probably pretty traditional moves in asset prices. If the Republicans win big, oil companies and banks probably benefit from that. If Democrats win, clean energy probably benefits from that. A Trump win probably benefits U.S. capital goods companies that do a lot of manufacturing here that stand to benefit from tariffs. More than sectors, I think with the capital gains proposals on the table from the Democratic side of the House, I think you'd probably see some selling in the end of 2024 and again in 2025, because most likely capital gains rules would go into effect, in 2025 going into 2026. So I think that probably would put sort of a wet blanket on the market a little bit if people try to sell and reposition ahead of that. As I mentioned, I think I see most of those movements as kind of things at the margin. I don't think either result is going to matter as much the overall economic situation as just the state of the economy, which is still in a sort of a slow growth phase. We're perhaps teetering on a recession, but we're not in a recession currently. We're just growing slowly. So we'll talk more in the fall if the policy positions evolve materially. And when we have a result from the election, obviously we'll talk about that and what the implications are for investors. So hopefully, again, like I said, I hope this was helpful. If you want to have more dialogue about your portfolio and how the election might or might not impact that, your own financial plan, always happy to do that. There's a link to connect with us in the notes. So feel free to reach out anytime, and we will talk to you down the road.